There's a moment in every technological revolution when excitement crosses a threshold and becomes something else, something sharper, more fragile, more dangerous. And right now, in early 2026, we're standing in that moment with artificial intelligence. Over the past year, we've watched the world's biggest tech companies gain and lose over $1 trillion in market value in a matter of days. We've seen investors celebrate record highs while simultaneously pouring unprecedented amounts of money into defensive positions. And we've heard the whispers grow louder. Is this the beginning of an AI bubble, or worse? Are we already inside one? The truth is, the signals are mixed, and that's exactly why this conversation matters. On one hand, artificial intelligence is delivering real breakthroughs. Enterprise adoption is accelerating, productivity gains are emerging, and compute demand is still rising. On the other hand, valuations are stretched, capital expenditures are exploding, and investor anxiety is at its highest level since the dot-com era. The tension between hype and reality has never been sharper. So in today's episode, we're going to peel back the layers, cut through the noise, and ask the question everyone else is dancing around. What happens if the artificial intelligence boom hits a wall? And just as importantly, what happens if it doesn't? If you've been listening to this podcast series and watching our live streams, webinars, or any of the video content that this series produces, you already know we're a huge believer in tools that make digital communication simple, professional, and reliable. And that's exactly why I use StreamYard and their advanced plan for everything I do: audio, video, live streaming, and on-air webinar sessions. StreamYard gives you a studio-quality experience right in your browser. No downloads, no complicated setup, just clean, powerful production tools that let you focus on delivering your message. With the advanced plan, I get multi-streaming to multiple platforms, custom branding, local recordings, and the kind of stability you need when you're broadcasting to a global audience. It's the backbone of my digital workflow, and it's the reason my shows look and sound the way they do. If you're ready to elevate your podcast, live streams, webinars, or digital events, I highly recommend checking out StreamYard for yourself. Our referral link is in this episode's description, so take a look, explore the features, save a little money, and see why so many creators and professionals trust StreamYard to power their content. And now, let's get this episode started. The investor mood. Fear behind the euphoria. If you look at the headlines, it feels like we're living in the golden age of artificial intelligence. Markets are hitting record highs, tech giants are announcing breakthrough after breakthrough, and artificial intelligence is being positioned as the engine of the next industrial revolution. But beneath that surface-level optimism, something more complicated is happening. Investor surveys show that 57% of global investors now believe an AI-driven tech plunge is the single biggest market risk of 2026. That's not a fringe opinion. That's the majority of institutional capital quietly bracing for turbulence. And when the people who move markets start hedging their bets, it's worth paying attention. What makes this moment so fascinating is the contradiction at its core. On one hand, we're seeing unprecedented enthusiasm for artificial intelligence's potential. On the other, we're watching investors pour record amounts of money into money market funds, bonds, and defensive positions. It's a split personality, euphoria on the surface, anxiety underneath. This divergence between soaring valuations and rising fear is one of the clearest early warning signs of a potential correction. Markets don't wait for fundamentals to break. They react to the expectation that something might break. And right now, the expectation is shifting. This is the emotional landscape of the artificial intelligence economy in 2026. Excitement mixed with caution, optimism shadowed by doubt. Investors aren't running for the exits, but they're keeping one hand on the door. And that tension, between belief in the future and fear of the present is shaping everything that comes next. The big tech shockwave, a trillion lost in days. When we talk about volatility in the AI era, it's easy to think in abstractions, percentages, charts, trend lines. But nothing about what happened recently was abstract. In just a matter of days, the world's largest technology companies collectively lost over $1 trillion in market value. That's not a typo. That's not a rounding error. That's a $1 trillion shockwave ripping through the most powerful sector of the global economy. Companies like Microsoft, Amazon, Nvidia, Meta, Google, and Oracle, businesses that have defined the artificial intelligence boom, suddenly found themselves at the center of a market storm fueled by one thing: doubt. And that doubt wasn't about whether AI is transformative. It was about whether the pace, the spending, and the expectations have outrun reality. Investors started asking hard questions. How much AI infrastructure is too much? When will the revenue catch up to the CapEx? Are we building for demand that doesn't yet exist? Those questions triggered a sell-off that exposed just how fragile the artificial intelligence narrative can be when confidence wavers. It wasn't a collapse, but it was a warning, a reminder that even the giants of the digital age are not immune to the gravitational pull of market psychology. What makes this moment so important is that it shattered the illusion of invincibility. For months, big tech felt untouchable, buoyed by AI optimism and record-breaking valuations. But a $1 trillion correction in a single week forces everyone, investors, executives, policymakers, to confront the possibility that the AI boom may not be a straight line upward. It may be a roller coaster. And if this was the first major drop, the real question becomes, how many more are ahead? Is this a bubble? Understanding the mechanics. When people hear the word bubble, they often imagine a dramatic, economy-wide implosion, something like the dot-com crash or the housing crisis. But not every period of overvaluation ends in catastrophe. In fact, most don't. So before we label the current artificial intelligence surge a bubble, we need to understand what actually defines one. A bubble forms when expectations rise faster than fundamentals, when investment becomes driven more by momentum than by measurable value, and when the narrative becomes more powerful than the numbers. And right now, parts of the AI ecosystem are showing those classic signs: soaring valuations, aggressive capital expenditures, and a belief that growth will continue indefinitely. But that doesn't automatically mean we're headed for a collapse. The key distinction is this: a correction is likely, but a systemic crisis is not. Unlike the 2008 financial meltdown, the AI boom isn't being fueled by excessive leverage or risky debt structures. Companies are spending aggressively, yes, but they're spending with cash, not borrowed money. That means if valuations reset, the pain will be felt primarily by shareholders, not by the global financial system. In many ways, the more accurate comparison is the dot-com era, a period of genuine innovation mixed with unrealistic expectations. Some companies soared, some disappeared, and the survivors went on to define the next 2 decades of digital life. So the real question isn't whether artificial intelligence is overhyped, it's which parts are overhyped, which are undervalued, and which are built to last. Because bubbles don't just destroy value, they also reveal it. And as we move deeper into 2026, the market is beginning to separate the speculative from the sustainable. That's where the real story begins. What could trigger a 2026 correction? When we look at the possibility of an AI-driven market correction in 2026, it's not about predicting doom, it's about understanding the pressure points. And one of the biggest is overinvestment without clear returns. Big tech is pouring tens of billions into data centers, GPUs, and artificial intelligence infrastructure at a pace we've never seen before. But the revenue models behind that spending are still forming. If enterprise adoption slows, or if AI tools don't deliver measurable productivity gains fast enough, the market could start questioning whether the investment curve has gotten ahead of the value curve. That mismatch alone could trigger a sharp reset in valuations. Another potential catalyst is capacity overshoot. Right now, companies are racing to build out compute power as if demand will grow exponentially forever. But if utilization rates flatten or worse, decline, investors will see it as a sign that the AI boom is outpacing real-world needs. Add in the possibility of regulatory friction, geopolitical tensions, or a sudden shift in investor sentiment toward undervalued sectors like energy, industrials, or small caps, and you have the ingredients for a meaningful correction. Markets don't need a crisis to pull back. They just need a reason to reassess. And finally, there's the psychological trigger, the moment when optimism turns into caution. If enough investors decide that AI valuations have run too far, too fast, the rotation away from tech could accelerate quickly. Corrections often begin not with a headline, but with a collective change in mood. And in 2026, that mood is already more fragile than it appears. Can a collapse be prevented? For all the talk about bubbles and corrections, it's important to recognize that the artificial intelligence economy isn't built on the same fragile foundations that fueled past market disasters. One of the strongest stabilizing forces is the financial health of the companies leading the AI revolution. These aren't speculative startups burning through borrowed money. They're some of the most profitable companies in history, sitting on massive cash reserves and diversified revenue streams. Their AI investments, while aggressive, are funded by real earnings, not risky leverage. That alone dramatically reduces the likelihood of a systemic collapse. Even if valuations reset, the underlying businesses remain strong, and that strength acts as a shock absorber for the broader market. Another factor working against a collapse is the genuine, measurable demand for AI capabilities. Unlike the dot-com era, where many companies were selling visions rather than value, today's AI tools are already reshaping workflows, accelerating research, and transforming industries from healthcare to manufacturing. Enterprise adoption may not be perfectly linear, but it's real, and it's growing. As companies continue integrating artificial intelligence into their operations, the long-term revenue potential becomes more grounded and less speculative. That steady structural demand helps anchor the market even when sentiment wavers. And finally, institutional capital is still flowing into the AI ecosystem. Pension funds, sovereign wealth funds, and major asset managers aren't treating AI as a fad. They're treating it as a foundational technology. That level of long horizon investment creates stability, even during periods of volatility. So while a correction may be part of the journey, a full-scale collapse is far less likely. The fundamentals are stronger, the use cases are clearer, and the long-term trajectory remains firmly pointed toward growth. So, what should smart leaders and professionals watch for? As we navigate the uncertainty of the artificial intelligence economy in 2026, the most effective leaders aren't the ones trying to predict the market. They're the ones watching the right signals. And one of the most important signals right now is the CapEx to revenue ratio across major AI players. When companies are spending tens of billions on infrastructure, but the revenue tied directly to AI services isn't scaling at the same pace, that imbalance becomes a pressure point. It doesn't mean disaster is coming, but it does mean the market is paying attention. Leaders should be watching how quickly those investments translate into real, measurable returns. Another critical indicator is cloud and GPU utilization rates. These numbers tell the real story behind AI demand. If utilization remains high or continues to climb, it signals that enterprises are actively deploying AI solutions and integrating them into their operations. But if utilization softens, even slightly, it could be an early sign that the market is cooling or that capacity is outpacing adoption. Pair that with enterprise AI adoption metrics, how fast organizations are moving from experimentation to production, and you start to see a clearer picture of where the momentum is heading. Finally, keep an eye on capital rotation. When investors begin shifting money into value stocks, industrials, or small caps, it often signals a broader reassessment of tech valuations. This doesn't mean AI is losing relevance. It means the market is recalibrating expectations. Smart professionals don't react emotionally to these shifts, they interpret them. They understand that every technological revolution has moments of volatility, and those moments often reveal where the real long-term opportunities lie. If you've been following my work, whether it's podcasting, live streaming, or the digital content I produce across platforms, you know I'm always looking for tools that elevate both quality and efficiency. And one of the most powerful tools in my workflow right now is 11 Labs, specifically their Creator Plan. The Creator Plan gives you access to some of the most advanced AI voice technology available today. We're talking natural, expressive, studio-grade voice generation that's perfect for narration, promos, training content, and even multilingual delivery. It's fast, it's flexible, and it integrates seamlessly into a modern creator's production pipeline. Whether you're building a brand, producing educational content, or scaling your digital presence, 11 Labs gives you the ability to sound polished, consistent, and professional every single time. If you're ready to take your audio production to the next level, I highly recommend checking out the 11 Labs Creator Plan for yourself. My referral link to set up your account and save a little money when you pay for a plan, well, that link is in this episode's description, so take a moment to explore what 11 Labs can do for your content. The Creator Plan isn't one of those tools that doesn't just improve your workflow, it transforms it. Create smarter, create faster, create with 11 Labs. And now, let's close out this episode. Closing perspective. Hype cycles don't define the future. As we step back from the noise, the volatility, and the trillion-dollar headlines, it's important to remember that hype cycles are not the story of technology. They're just the weather patterns around it. Every major innovation, from electricity to the internet, has gone through periods of inflated expectations followed by sharp corrections. Those corrections don't erase the technology, they refine it. They separate the speculative from the sustainable, the noise from the signal. And artificial intelligence is no different. Whether the market cools, corrects, or simply recalibrates, the long-term trajectory of artificial intelligence remains anchored in real progress, real adoption, and real transformation. What matters most is how we respond. Leaders who stay grounded in fundamentals, who understand the difference between momentum and value, will navigate this period with clarity. Professionals who stay curious, adaptable, and informed will find opportunities even in the turbulence. And companies that focus on practical, measurable AI integration will emerge stronger, not weaker, from any market reset. The future of AI isn't defined by the peaks or the dips. It's defined by the steady march of innovation happening underneath them. So as we close this episode, remember this: hype cycles come and go, but the digital revolution continues. The real question isn't whether artificial intelligence is in a bubble. It's how we choose to build, lead, and innovate through the uncertainty. And that's a conversation we'll keep having right here together on this podcast series known as The Digital Revolution with Jim Kunkel.